Hi guys! We are going to look at how to calculate cash-on-cash return on a rental property. We are going to break it up into 4 simple sections to help you evaluate if a rental property is a good investment or if you should run away from it. I call this the rental quadrant. There are many additional factors that goes into the evaluation, such as the desirability and location of the area, but we will keep it just on the numbers today. I am going to switch the screen here quick. Here we go! Let's use a made-up property to evaluate that's for sale on 123 Cash Flow Street. This is a duplex, which means there are 2 units available to rent out on each side. The price for the duplex is $200,000. Let's look at quadrant number 1. This is the income quadrant. This duplex can rent for $1,000 per month on each side, so the total rental income per month is 2 times $1,000, which is $2,000. That's easy enough, right? Sometimes there can be other income sources such as laundry income and leasing storage, but we will skip those in this example. Cool! We are done with the income quadrant. Quadrant 2 is the expense quadrant. Here's a list of the typical expenses that we want to keep track of. Here we go! There's property tax, insurance, utilities such as gas and electricity, vacancy cost, repairs, capital expense, property management, and usually the biggest expense, mortgage. Let's fill in some ballpark numbers for each. Remember, these are costs per month. $150 for property tax, this can vary depending on your area. $100 per month for property insurance. In this example, the tenants are responsible for utilities, so we can mark this 0. $100 for vacancy. There can be times after a tenant move out and before you fill the unit with new tenant, so we can estimate the loss of rent here. $100 for repairs. This is the amount that can be put aside each month for repairs such as fixing plumbing, replace stove, things like that. $100 for capital expense. We would put $100 aside each month to save up for larger budgeted items like furnace, air conditioner unit, and roof replacement. These are examples of capital expense. $150 for property management fee. Even if you manage the rental yourself, you want to add this in the calculation to give you the flexibility to hire a property manager as an option. Lastly, the big one is mortgage. It is typical for an investor to get an 80% loan and there will be a monthly mortgage payment associated with that. Mortgage rates and terms can vary, so let's use $850 per month for this expense. Phew! That's a lot of line items! When we total up the expenses, it comes out to $1,550 per month. Alright, we are done with the expense quadrant. The third quadrant is the cash flow quadrant. This one is easy. You take your gross rental income, which is $2,000, subtract the total expense of $1,550. That gives you a monthly cash flow of $450. Is this good or bad? Quadrant 4 can help with that. Quadrant 4 is cash-on-cash return on investment. First, we have to add up the initial total investment amount. This includes the down payment, closing costs, and rehab costs. With 20% down payment for the purchase price of $200,000, that comes out to $40,000. Closing costs include several things like the title company, adjusters, loan processing fees, loan documents, and we can use $3,000 for that. Rehab costs will be different for each property, so let's use $7,000 in this example. So what is our total investment? We add these up and get $50,000. The cash-on-cash calculation is using the annual cash flow, $450 times 12, which gives you $5,400 per year. Using $5,400 divided by $50,000, the initial investment amount, and that gives you 10.8%. That's pretty good! Think about what other investments you can get a 10.8% return. Hopefully you get a good understanding of how to calculate the cash-on-cash return. If this video helps, please hit that like and subscribe button, and let us know in the comments section.
If you like this video, please like, share, subscribe, and hit the notification bell.